All right, so now we have learned about how money works, why it is important to invest, and why these crashes occur. And we've also seen how important it is to pay yourself first so that you have more money eventually, and also you make sure you always have enough money to invest. So now we can look into strategy. You see, after I've made my first loss of about 90%, I vowed to learn the best and safest investment strategy. I made it a point that no matter what happens, no matter what it takes, I'm going to go out there and learn which is the best and most safest investment strategy that will cause me to never ever lose money and make tons and tons of returns. So I spent 5 years looking for it. I learned value investing, dividend investing, options, Forex, technical analysis, PE ratios, discounted cash flow, and so much more. But eventually, what I realized is there are tons and tons of different strategies. You need not and you cannot do all of them. You only need one strategy that works for you and do it consistently over time so that you reap the rewards. Now, looking back, I realized that investing is like trying to lose weight. If you had a goal to lose weight, you don't need to run and swim and cycle and go to the gym and learn how to play tennis and learn soccer and learn football and play baseball, etc., etc., etc. Just one sport will suffice, right? You only need to do one of them. What is most important is that you enjoy what you're doing and therefore you do it consistently so that you actually reap the rewards. It's no point going swimming one day and then not doing anything for the rest of your life. You would much rather be better off doing cycling if that's what you really prefer and enjoy, but do it either every day or 3 times a week, and then you will see results and you probably will lose some weight. So, likewise, in investing, I hear all too often from my friends, they say, I've tried investing before, but I stopped because I don't have the time to analyze financial statements and keep up with the news. Or some of my friends say, I tried investing before and my stock went up for a month, but then afterwards it crashed a week later. Or some of them say, I cannot invest. Investing is not for me because I'm not the investor type. I don't follow the news much, so there's no way I can invest. In order to overcome all these problems, what we need to do is examine our goals and preferences and any limitations we have and create a strategy around it. So, for example, if you are trying to lose weight, but the nearest gym was an hour's drive away, then you might be better off finding a home based workout and doing it consistently so that you achieve your goal of losing weight. Likewise, in investing, we need to examine what our goals are, what preferences we have, such as some of us may not like to look at charts, or some of us may not like to analyze numbers and look at balance sheets and so on, and any limitations that we have. For example, a friend of mine said that he works 12 hours a week, so he has very little time to actually look into company financial statements and so on to invest. All these limitations can be overcome by finding a suitable strategy. The reality is that all strategies will have great years and some not so great years. There is no one strategy that is going to outperform everybody else every year. Consistency is actually the key. So, in order to create a strategy that's going to work for you, the first question you need to ask yourself is how much time would you like to or can possibly spend on your investments, say every week or every month or every year? The reality is that some strategies are surprisingly effective, as we will see shortly, and they take as little as 30 minutes a year, not a day, a year. Second question to ask yourself is how long would you like to hold on to an investment? Do you prefer to buy and sell frequently or only once in a while? You see, some of us are more long term investors. For example, if I buy a stock, I'm more than happy to hold it for 2, 3, 4 years if as long as the company is doing well. However, some of my friends, as soon as they make some profit, let's say a few $100s or a certain percentage, they would sell it and then try and look for the next opportunity. The third question to ask yourself is what's your goal? Do you want to have a big sum of money at age 55 or 60 when you retire? Or do you want to create monthly income in the next few years? Certain investments do not give you a monthly income, and certain investments do give you a monthly income. So accordingly, you will be using different strategies. And lastly, do you have any preferences? For example, some common ones are I don't have the time, or I dislike reading financial statements, or I hate looking at charts, I just don't get them. All these challenges can be overcome by creating a suitable investment strategy. So when I went out, I tried to learn all kinds of things, trading, dividend investing, value investing, CFDs, stocks, REITs, ETFs, options and rebalancing. And then some people said, you should buy and hold it forever. That's the best way to invest. Some of them said, no, that's crazy. You should sell quickly and take profits as soon as you can. However, eventually what I realized is that there is no one size fits all. It all depends on what suits you, and therefore what is it that you're likely to do consistently. Because investing is not a 6 month or a 1 year game, it's a consistent affair. So look at your goals, and then you look at what kind of time horizon you have and how much time you have available to spend on investing. And accordingly, you create a strategy that works best for you. So, having understood that, let's look at some typical avatars that I have come across through my interactions with friends and others. For example, some people say, I want a nice big sum of money at retirement at age 55. I don't want to read financial statements and reports. And also, I don't want to spend more than 30 minutes a year managing my investments. Well, I have news for you. You can do this. In fact, there is one strategy that, if used from about 1971 to 2012, would have transformed $10,000 into over $400,000 with only 3 years of negative returns, which means starting from 1971 to 1972 to 1973 and all the way till 2012, if you look at the yearly performance, there was only 3 years that your portfolio would have been down, and the most that it would have been down is about 4%. Let's look briefly into how this works. In order to understand how such a strategy works, we need to first understand what an index fund is. An index fund is a type of mutual fund with a portfolio constructed to match or track the components of a market index, such as the Standard & Poor's 500 index. So what that means is that it is a fund that invests in several different companies so that it gives you broad market exposure and low expenses and low portfolio turnover. So for example, if you bought an index fund that tracks the S&P 500, you would be buying into 500 of America's top companies. Another thing to understand about index funds, as this article explains, almost no one can beat the market. And they say, seek shelter in low-cost index funds. And they say that year after year, decade after decade, evidence has piled up that neither individual nor professional investors can outperform the broad market indexes consistently over long periods of time. So by buying the index fund, you are doing better than a lot of people, and you don't have to go through financial reports or statements or anything like that. And your risk is lesser than if you picked an individual stock, because if you pick an individual stock, the company could potentially go bankrupt. But if you bought an index fund with so many different companies, such as 500 companies in case of the S&P 500, even if one or a few companies go bankrupt, it doesn't make or break your portfolio. So having understood that, let's look at this website called portfoliovisualizer.com, and let's see how you can invest by spending just 30 minutes or so a year. Let's say you start off with $3,000, and let's say you buy an index fund for stocks. An example could be SPY, which is the index fund for the S&P 500. Then you buy another index fund for, say, bonds, for example, and you buy another index fund for gold. And I'm going to put 30% of my money in each one of them. And the remaining 10% of my money, I'm just going to hold cash. So 10, so 30, 30, 30, 90 plus 100. And what I'm going to do is I'm going to rebalance annually. Now, this is key to understand. This is what takes the 30 minutes. As we learned previously, no investment goes up forever. They all go in cycles. So stocks, for example, they go up, they go down. Bonds, the same. Gold as well. Any investment you take, real estate, they all go up and down. They all go in booms and busts and cycles. So what rebalancing annually means is that, let's say I started off by putting 30% of my money in stocks, 30% in bonds, 30% in gold, and 10% cash. Let's say at the end of year one, I find that my money has grown, but these percentages are skewed. Let's say now my 3,000 has become, say, 3,500. However, out of this 3,500, 40% of it is in stocks. What that means is that stocks have gone up and relative to gold and bonds, for example. Put another way, it means that stocks have been going up and the other investments have been going down. Now we know that that cannot happen forever. Everything goes in cycles. So what rebalancing annually means is that you sell some stocks until it becomes 30% of 3,500. Let's say if it's 3,500, you sell some stocks until they become 30% of your portfolio again, and you buy some of the other things until you get back 30%, 30%, 30%, 10%. That's what rebalancing annually means, and that's what takes you the 30 minutes a year. So let's go and see how this would have performed historically between about 85 to 16. Let's see how much data we can get. So I'm going to go to annual returns, and it's only giving me data from 2005, but it's a good start. So let's see. My total return for 2005 would be 9.66%, 12.21%, 14.23%, 0.77%, 8.59, 16, 13, 7. Now here I lost a little bit of money, 2.8%, not too much. 11.57%, lost a little bit of money, 3.36%, not too big, and then 6.49%. Now what is most interesting is this year, 2008. In 2008, stocks took a massive hit, as we know, because of the financial crisis. They went down 36.81%. However, bonds, the bond ETF, it gained 33%. The gold trust gained 4.92%. And therefore, even though the stock market crashed almost 40%, in this portfolio, you would have made 0.77%. How impressive is that? Now, this takes advantage of the fact that everything goes in cycles. If something is going down, like stocks, something else could potentially be going up. Of course, in theory, it is possible that everything goes up or down at the same time, but typically, this is what we would expect. If stocks are taking a massive hit, something else is quite likely going up. So if you spread your investments, your portfolio would be safe and you wouldn't be losing too much money, and you can invest by spending just half an hour a year. So as we can see, there are investment strategies that do not require us to read financial reports or keep up with the news or anything of that sort, and they only take about 30 minutes a year. However, the strategy that we just saw is a capital gain strategy. What that means is that it grows your wealth, but it does not generate any income or cash flow. So the next avatar that I frequently meet when I talk to my friends and others is that I want to create a monthly income from investments, but I still don't want to read financial statements and reports. And I understand that generating this monthly income can take a little bit more time than half an hour a year, so I can spend, say, 30 minutes a month to create this income. This can be done too. What we do is we take that same index fund that we talked about previously and we sell options on it. Using options, you could generate about 2% monthly income from your investments. So say, for example, if you wanted a monthly income of $200, you would need a portfolio of about $10,000 and you could generate about a 2% return on it, or a $200 monthly income from it. And the final avatar that I meet when I talk to friends is I love investing and I'm willing to read financial statements and reports of companies to get better returns and take advantage of unique opportunities in order to grow my portfolio and generate an income from it. So in this case, we would dive into how to analyze a financial company, financial statement, how to analyze whether it's a safe company to invest in, how to maximize our chances of success. Of course, nobody gets it right all the time, but if you do get it right, the returns can be phenomenal. For example, as I shared earlier, this year, one of my stocks, it doubled in about 7 months. Now, if none of these appeal to you, then I would love to hear from you, because these are the three avatars that I've met most frequently. But if none of those appeal to you, if you have any special limitation or something like that, I would love to hear from you. I'm very passionate about talking to people about investing. So right at the bottom of this course, you would find the link to book a 10-minute call with me. or you can write to me via email, and you'll find those details at the end of this course. Let's look at some frequent investing myths. One myth that is out there is that the more time you spend, the better the returns. The reality, as I've found through my research, is that the most time consuming strategy is actually the one where the fewest people succeed. If you're curious to know, that strategy is called scalping. And essentially, what it means is that you sit down for an hour or 2 hours and you buy and sell, buy and sell, buy and sell, buy and sell many, many times, 15, 20 times perhaps, in those few hours in a hope of making a high return. However, research shows that only about 1% of people who do that actually succeed. The next myth is that strategy X is the best because of yada yada reason. The reality is that all investors, including legendary investors like Warren Buffett, they also have some years of not so good performance. And as we discussed earlier, it is consistency that's always the key. Lastly, the last myth I hear is that you have to analyze financial statements and invest in individual companies to get a decent return. The reality, as we saw previously in that article from MarketWatch, is that most investors over the long term do not beat the index.